So this is a class called Why 20 Days Matters. And at the end of the day, it's more of a class on one piece of information that's extremely important. Risk interval. Risk interval is the structure of everything futures. Now, it is one of our price calculations. It's something that I created. It's something I reverse engineered from something the CME group created. Now, you may not understand what the most important piece of information that you could have as far as anything related to futures is. It's actually called something called product margins, margin requirements. You probably overlooked this number, never thought anything of it, but this number that I'm about to give you and show you how how everything is tied together is the most important number when it comes to futures trading. Having this number with you every single day when you go to trade is so important. It has to do with almost half of our future, actually almost all of our futures calculations and half of our total calculations. There's sit out calculations related to margin. I mean, it's really neat how it works. I'm going to go into a small little story about how futures are tied together in general. You might not have ever thought of it, but when you go out there and you buy something from your broker, right? You have a broker that you're trading with that might say, okay, you can trade S&P futures contracts for $500, right? You guys have discount brokers, Tradebate, and any of these other ones, right? They say, congratulations, $500. Welcome to your brokerage account. It only costs $500 to trade one ES mini or one NASDAQ mini. Great. That's how much it costs. However, you might not know that there's a whole bunch of pieces to the puzzle. You're not just out there just trading and one person, like you go straight to the market. There's a lot of stuff that happens. The CME Group is a publicly traded company that created something called the Globex. It's an electronic exchange where orders take place. And so the Globex itself is where orders are executed electronically. So I'm going to put a G right here with the box on it. And so for an order to go to the Globex, you have to make it all the way up the ladder. Now, there's another piece of the puzzle called clearing. And now, when you go look at your broker statement, you're going to see that you have everything from every time you make a trade, you're going to see something called like an exchange fee, a clearing fee, a brokerage fee, right? You guys see all these commissions, right? And you didn't know what they all went to. Well, that's this. Every piece of the puzzle, every piece of the pyramid takes a little bit out of your trade as far as the commission, how it works. So a broker, so how this works. CME Group sets a product margin. And you go to CME Group's website and get these things for every single contract. But let me go ahead and just skip all of that and just show you. We're gonna convert this into a usable number as far as a range goes. Now, maintenance long and maintenance short have everything to do with position sizing. You're going to use this number for position sizing, and you're going to use our derived number for a lot of your other calculations. So they published this number. And what that number means is despite you having to pay $500 to trade one ES contract, as you see, the CME Group requires performance minimum or maintenance minimum, performance bond minimums or maintenance margins to hold this contract of this much. So 15,271 is the amount of money you actually have to have into that trade. Initial margin requirement is 1.1 times your maintenance. So if you take this 15,271 times 1.1, that's the amount of money that you need to actually hold the contract on the long side. So let's do the math really quick. 1,89761. Okay. So 16,798. But your broker only charges you $500. So who is this requirement actually for? It's actually a requirement for something called a clearing firm. A clearing firm is kind of like a bookie that makes sure is that, you who are longing something with your broker and someone else who is shorting something with their broker, it doesn't matter what your broker charges you, your broker has to come up with this much total between the two of y'all. And so typically, your broker is going to be putting the rest of the money into the pot. 16,298 is they're going to put in towards the trade. You bought one futures contract, they're putting that much money in there and it's going in the pot. Clearing looks at the person that's shorting and they ask the same thing. You guys putting in the pot as well? Okay, you guys put in. You trader and your broker have money. Okay, you trader, your broker have money. Good. And clearing makes sure that the winner gets paid by the loser of the trade. And then clearing makes sure that that happens before the order goes to the Globex. And the CME is like basically setting the rules for all of this, right? And then there are, of course, underneath like the NFA and CFTC regulations and all that. But anyways, so whenever you make a trade, you pay a fee to clearing, you pay a fee to CME, and you pay a fee to your broker for all this to happen. So that you can go out there and get your nice little $500 margins to trade on a discount broker. Now, This margin requirement is set meticulously using a program called SPAN. And a very, 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 very quick and easy way to understand that, you can go to CME's website and read up on it. Basically, it looks at all these reportable positions of these big entities. And you think of market makers, investment banks, whatever. And so they basically report, where am I long and short this contract? And people might be saying, look, I'm short all up in here. And other people are like, maybe I'm long down in here. And then the majority of the distribution is like right there and right there. And maybe people are speckled throughout. But if the bulk of the long, the bulk of the short is like that, then clearly there's a problem. If the market tends to move below everybody's long, it can start causing a cascaded waterfall of margin calls. Same thing if you blast through all the people that are short and cause a problem as well. Based on where everybody's positions are distributed, the CME group actually uses a very rigorous calculation to come up with this number. So essentially, where everybody's positions are spanned out, that's the margin requirement. Well, I came with this great idea to figure out how this equation actually works. And what I do is I take this margin requirement and I reverse engineer that range to find out where people's positions are. Enter something called the risk interval. My first claim to fame in 2016 was inventing the method to reverse engineer CME's own SPAN program. And I'm going to put you right in front of you something called DD bands, which is using that as well. One of the things you might have seen in some of our courses, or sorry, some of our videos to date, or even my streams, is that we have these bands that I always talk about. The market has 88% of days, since we did the last count, closes between the bands, 4% of days above and 8% of days below. And the bands are amazing pivots, like amazing pivots, right? When you touch them, they're amazing pivots. There's something interesting that happens on this band, but let's just go ahead and tell you that this is a reverse engineered number of one risk interval this way and one risk interval this way from the close, which again is calculated from those margin requirements. It's basically showing you where the dealers have high probability of margin calls on either side. They give us the margin requirement. I give you the range. They calculate the margin requirement from the range, and we reverse engineer that. Pretty cool, right? So as you see, you might let me go ahead and load up like S&P. As you see, a lot of days there's pivoting off of the bottom of this range. It's a structure point in futures. We use that same risk interval number, and this is where you get it from, calculating if there's a catalyst active in the market, when to sit out. You're going to go to your platform. You're going to click this little number right here, or sorry, this little menu right here, and you're going to scroll down to whatever contract you're looking for. And every single night before the futures market opens, we calculate this thing called risk interval. 42 points is the magic number in futures. What it does is it tells you a couple of things. It's the amount at which futures can move away from the stock market when it's closed to search for a new liquidity point. An example, CPI, right, happens pre-market and the market jumps very quickly a distance before it figures out what it wants to do. That distance actually is that risk interval. It has everything to do with people having margin calls and has to do with where the risk is distributed in the market, especially in the market makers. We can go back and I can show you a couple examples of these catalysts. Let's do 42 points. This is an icebreaker because we will have a class on catalyst. This is the S&P. And 42 points from 59.01 goes all the way up to 59.43. And you can see that when I go to a tick chart, which is where you can see it, at exactly 59.43 is where you're going to see that first run pivot. Like literally, let me kind of zoom in right here. So it starts at actually, sorry, 5,900 plus 42 is 59.42. And it shouldn't surprise you that right here, 59.42 is where that first resistance is. You didn't know that you could take the margin requirement and calculate how much the futures market moves in discrete intervals to search for liquidity in sudden bursts of like an event, or in the overnight session when the futures market is closed. This band is actually that same distance here and here. All of that is built on the margin requirement. What we noticed was that when the futures become more volatile, the margin requirements would suddenly become bigger. And more volatile, they become bigger. And when volatility would come down, become smaller and smaller, which makes sense. It's because volatility is how far apart your buyers and sellers practically are, how much the market V's around looking for those buyers and sellers, right? More volatile, less volatile. Why do they make the margin requirement more when the volatility goes up? It's because dollar for dollar, there's fewer contracts in circulation. There's the ice is thinner at the bottom, and here the ice is thicker. There's more people here. It's thinner. So if a margin requirement is $5,000 for every $10,000, you can buy two contracts. But if they made it $10,000, you can only buy one for the same dollar. So when the volatility is supposed to be much bigger, they make it harder to trade so that fewer people are getting squeezed out at the boundary, so that it's not like a shotgun blast causing margin calls. It's only a trickle of contracts. Wider the market, more expensive to trade. Do we understand the relationship? It's very important to understand how volatility ties into everything. This number is going to be your favorite thing you've ever learned anywhere. Are we on the same page? Everyone, say something in chat that you can hear me. Yes. Are we on the same page? It can calculate how far markets can move overnight. Futures markets move until it hits a comfort zone, right? Gosh, that was loud. When you touch one risk interval above the close of the previous state, you will see there is high volume as you're breaking through it. And as you're breaking back down through it, there's high volume. Something interesting is happening exactly that distance from the close as well. So the close price of futures the previous day spans that distance, and that is where that is. Okay. And what's neat about it is even that day on PPI, we went exactly to the DD band before it rejected, right? You didn't know that that is a packet of information to take with you. So some cool tricks with the risk interval that I'm going to show you guys um, is is your position sizing. Now, one example, if you're trading in a real futures account and you don't know what a good position size is, we always tell you we have a guide. We say we have a normal guide of what you would normally trade. Then medium is one half of your normal. Then small is 1/10 of your normal. And zero is a sit out. Get used to something like this because we're going to cover this very heavily in the next class. Your normal, if you need a definition, I gave you a loose definition. It is how much are you willing to lose 5 times of in a row at the end of the week and not feel like you got kicked in the stomach? If that number is whatever it is to you, that's your normal. If you can say, you know what, if I lose $10,000 at the end of the week, I'm totally fine. Your normal may be $100. Whatever you lose at the end of a week, losing 5 in a row, and you don't feel sad or sick, that's a good normal for you. You never want to trade too heavy to which the market's hurting you at the end of a bad week. Do we all understand? So every trade you're going to take is going to be at least that comfortable amount or less. You're never now going to have a trade that's going to feel bad. This position scaling trick is how I win competitions and how I do well and recover from losses. Okay. You define your normal. So if you want to define a normal, however you feel like you want to do it, we also have another rule. This rule is really good at defining a normal if you need a numerical normal. So what you can do is you can take the net liquid or the net liquid of your account and divide it by that 1.1 times that maintenance requirement. There's something really interesting that happens when you do that. But let me kind of show you a little trick. If I had $100,000 in that account and the margin requirement for whatever we were looking at, the S&P was whatever it was, 15,271 for the current contract. 15,271, okay? So 15,271 is 169,15271. Oh, wait, sorry. 15,271. You stick to do the mental math. So that's going to be 16798 is 1.1. So if I take 100,000 and divide it by that much, I get a number, 5.95. 5.95 is the max amount of E-minis I need to be trading with a $100,000 account. What this does is it uses the margin, which is balancing the risk. Remember, every time you think margin requirement, think range. All right, got it? I say margin requirement, you say what? You guys are too slow. When I say margin requirement, you say range. When I say margin requirement, you say range. So bigger the margin requirement, smaller the contract. Smaller the margin requirement, bigger the number of contracts for that amount. So, what does 6 contracts, let's round it up, look like in the current state of the market? Remember, 88% of days tend to move on S&P or NASDAQ, one risk interval on an event, which is the worst case scenario, right? Um, 42 points to that first resistance before it keeps going. So 42 points on an event, never 42 points in normal trading unless the market's just crazy volatile. We'll cover that later. But in the overnight, it takes all night usually to get 42 points on the S&P. Okay. So 42 points is a good span distance of, man, I held my position for way too long and I fell asleep and it fell 42 points. Because usually when you're trading the S&P, you're going to use a stop of roughly 10 points or less. Nasdaq, your stop is roughly going to be 40 points or less. And I'm going to teach you this as well. Write it down. But in case you fall asleep at the wheel, your risk interval is a ripcord that you pull if you're not paying attention. 42 points. Geez, that's like 4 times as much as that. You're never going to try to hold it that far. But let's go ahead and plan for it anyways. 155 on NASDAQ, right? These are those risk interval distances. So if I have 6 contracts on 100,000 and I stop 10 points away, every point on the S&P is $50. So 10 is 500 per contract times 6. 500 times 6 is $3,000. It doesn't really sound that bad with a 10-point stop and 100K account to lose 3% of your account. Prop firms, your net lick, we'll cover that in just a second. Remind me to get back to it. But does everyone understand that at a $100,000 account, 10-point stop at this is the equation right here, limits you to roughly 3% of your account. That's not that bad for a single day trade. If I lose 5 days in a row, 15,000, that might hurt. Nah, not 85,000. I can easily make that back. Okay, not a big deal. It's a good rule of thumb as a starting point. What happens if you fall 42 points? Okay, so let's do the math really quick. 42 points times 50 a point times 6 contracts is 12,600. If you happen to fall asleep at the wheel and then Donald Trump tweets something and the market falls 42 points before you can figure out what's going on, you go, oh God, I forgot to put a stop. Let me just pull the plug. Then you pull the plug, losing roughly 12% of your futures account. It's bad, but it's roughly what about a week's worth of loss would be with your normal stop. So in case you fall asleep at the wheel, this equation is the equation I've used to trade with for years. And this is the equation that keeps my net lick in check. This is the equation that made my stats in that trading account that I did for that contest look like this. Okay. It wasn't like this. Okay. As your account gets bigger, the position size you take gets bigger. As your account gets smaller, the position size you take gets smaller. Do we all understand the principle? So if you have that as the maximum position size you ever do, if you fall asleep at the wheel overnight, you're down like 12%. I mean, that's not a guarantee. It could go more. But when the market just blips on CPI or blips on PPI, you got roughly 12% of your account underwater. At least it's not 100% of your account. If you need a guide, there's a good starting point. You're using the margin requirement to understand that the market's going to span that distance before it finds liquidity, whether it keeps going or not. That's a pause point that allows you to have a little bit of time to catch your breath before it goes. And I could show you a ton of examples of every event, but we just showed you one, right? We showed you that the DD band is one risk interval from the close. That's always a place to go. Any catalyst or event, one risk interval from the bottom. Here's ES this day. 77 plus, well, actually, this might not even gone the whole distance, but yeah, this is roughly 42 points. So you can just measure it right here. It's pretty much the same distance. 75 plus 42 would be right up at 57. Or 17, which is right there. 42 points. The market relaxes a little bit sometimes, and sometimes reverses that distance. But you have to understand that throughout the rest of the day, I'm just going to show you something really neat. You might have never known this, but this is a box of, I believe, 42 points. Let me just go ahead and grab it and double check. Yeah, that's 5 and 9, 47. 5, 47, 47. Okay. This is exactly 42 points. And I'm just going to take this box and randomly drag it around how much the market spans to find new liquidity. And once you do this and I show you this, you can't unsee it that there just seems to be some magic range at which the market moves to its next equilibrium point under all conditions. I mean, you can do this hundreds of times. It's a really neat exercise. An event happens. Look, there's the distance, right? Big sell off at the end of the day. Look, there's the distance. Big recovery, end of the day. Look, guys, there's the distance. You didn't know the margin requirement was a packet of information. Welcome to what our classes are like. We tell you every class is a mic drop moment, but this is really neat. Okay, here's yesterday. Yesterday, big choppy market. Look at the distance it's chopping. Okay, there's something neat about that number based on margin requirements, and like a lot of people don't really think about it. You never put 2 minutes of your time to thinking that margin requirement is based on the range at which futures are expected to find liquidity. And as I drag this box around, the ups and downs without abnormal volatility, i.e., VVIX is below 100 or VIX is below triple B, the ups and downs or the V's are less than that distance or less than or equal. When the market's unusually volatile, it tries to span beyond it a little bit. But on your average days, even look at this crazy day, it's like the V is like up and down that box, up and down that box, or less. There's liquidity inside of that box because that's where everybody's position is. That's where the market moves to find liquidity because the dealers and the investment banks told them, I'm buyers down here. The other one's like, I'm sellers right there. Okay, there's the liquidity. Buyers and sellers are a certain distance, wherever it is. Not these green bands, but the distance that calculates this. So you can move the 42 points all over the place on the S&P. And how long do I need to do it until you're convinced there's something neat about the margin requirements? So far, so good. Are you convinced that these spans up and down, every little burp up seems to find comfort in that level, right? Here's the consolidate, move up that distance, tuck back in. Do we all see this now? Yes? Or do you need like 50 more examples? One thing you'll learn in the catalyst class is what happens when the market falls greater than that distance on an event. Remember when the Fed happened? You guys remember that? When the Fed happened, when you move greater than that distance on an event, you sit out no matter what because of this. Okay? This is called a catalyst. When the market has broken that liquidity structure on an event, we call it a catalyst. A catalyst has curvature, it speeds up as it falls. When a cat is active is one of the two things we do to sit out. So not only is that number used for position requirement or positioning, but it's also used to tell you the market's moved too far too fast for comfort. It has blasted through that liquidity and now is toppling over dealers and market makers, right? So when you move that distance on an event, you automatically sit out. And it's one of our sit out rules. We have a whole class on it. Okay. So now back to the neatness of that thing. It's a thing that allows you to basically cash equivalent your account to make futures be not so creepily leveraged. If you use that equation as your maximum position size, i.e. your normal, it's going to give you a nice little baseline to trade with. If your normal is designed such that a 10-point stop on S&P or 40-point stop is roughly 3% of your account, then your medium trade is 1.5% of your account. And your small is 0.3% of your account. And your zero obviously is zero. Would everybody here agree that at least in a futures account, which is supposed to be a little more accelerated, that upwards of anywhere less than 3% a day or per trade is probably tolerable? Just as a pop quiz. And again, normal you decide, but if you have a hard time making a choice, this is not a bad place to start, but you decide what you're comfortable losing with. So in a futures account, does this seem manageable? As the majority of your trades are going to be like this, right? Every $100,000, your trades are up and down 1,000 or less, right? Or 3,000 if you decide to hit it hard and your highest confidence, you're going to 3,000 is your risk. You're not blowing up your account a single trade. People have been watching me trade on stream for years. I've never blown up on stream. I follow this religiously. My trades are 2, maybe 5, maybe 6 or 7 if I'm really confident, rarely 10, but 10 is my normal, quote unquote. I almost never go there. Right? So you see my trades up and down per account, 3,000, 5,000, usually that much, right? And I keep it that way. And I'm always running that equation just to figure out. Now, what makes that equation really neat was that, remember we talked about the 20 days thing, right? We have a spreadsheet over here that kind of covers a little bit. If I were to set my target loss, right, for the S&P contract to be 10 or Nasdaq to be 40, and I have the margin requirement, which is 15,271. Let me put it in here. Hold on. Equals 15,271 times 1.1. It's going to give me a number. Now, if I'm losing 10 points per trade and I'm the blind monkey again, we're starting all the way over, and I lose 20 days at 10 points on a basis account size of, let's see where I started off at. Let me put 15,000 there. Let me do let's do something that's easier to see. Let's start off with 100K. Yeah. If I have 100K in my account, using that same equation, 1.1 times the maintenance requirement, you take your account size and divide by it. As you see, my max position size, oops, this all the way down here. All right. If I were to lose on 6 contracts, 3%, let me do this really quick. So remainder, if I took a loss, is that minus that. Targeted loss is 10 times 6 times. Oh, this was based on NASDAQ, sorry. 10 times that times 50. Yeah, that's more like it. So based on the S&P, if I were to lose on a 6 contract trade, $3,000 on a 10-point stop, right? Then the next trade, I have 97,000. I could trade smaller and smaller and smaller and smaller and smaller and smaller. At the end of 20 straight losses, using that equation, let me double check that my math is right. I think something is wrong here. This spreadsheet is shared with people, so I think somebody came and modified it. Oh, sorry, here it is. This is what's wrong. All right. So, do you notice something neat about your starting point and what happens 20 days later? How much of your account do you have left with this equation? Everyone take a guess. Not just one person take a guess. 97 people here. Go ahead and take a guess. About half. And what happens if you have half your account left after 20 straight days of losing and you're only randomly long in the market over time, the bull market catches up with you? Didn't we prove that that's not a bad deal? In this particular spreadsheet, it shows you that that equation matches up pretty nicely with throttling your position. At the end of 20 days, you're only trading 3 contracts rather than 6 as your normal position. And if you lose all 20 days, guess what? You still have half your account left. Does this make sense? Half. Does this match the experiment that we talked about? And if you keep going, you have half again the next 20 and half again, et cetera, right? Actually, probably even a little bit more. Let me keep dragging this down. So at day 40, you have 30,000, right? You have a little bit more than half of 50. You know, at day 60, like if you lose 60 straight days in a row with this equation, you're still trading 1 mini and you still have roughly, you know, a huge chunk, like enough back to kind of make some money back, right? To trade. But you're not going to lose 20 days in a row or 80 days or 60 days. But what you see is at that position size, it manages such that pretend that you're randomly long in the market. Only half of those days are going to be losers and half of those days are going to be winners. So you're not even going to get to half, right? Do you understand that this is connected? Just before I move on, the risk interval is designed for the mathematics of this type of have. The market works mysteriously in halves. Like market moves up a distance, tests the half, moves down a distance, tests the half. There's a certain amount of risk on the table. Market loses a half. Well, half of your account at least gives you something left to attack it for the next month. Now, another thing that makes this really neat. So far, everyone, this is neat. You got it? You like how that equation lines up perfectly? This is the blind monkey's equation. That's hitting it with their full confidence, normal size position. And again, if you have lacking confidence, like some of your indicators don't line up, you'll trade half of that or a tenth of that. You might trade one contract, maybe two. So you're never really fully stretching this. But this is, I hit every single trade of 20 days. Each day was a loss, and I hit it with my maximum confident position I have, and I lost, and I lost, and I lost, and I lost, and I lost. And I still, after getting my butt kicked for 20 straight days, just using an equation, I still had half left. Most of you are this, and I want to see in chat how many of you are this. If you can actually take 20 days to lose half of your account like this, there's actually talent that requires to do this because most of you are making money and you lose it all in probably 2 days. How many of you are that part of the equation? And it's okay if you are. You make it on, you lose it on a couple of days. You might wish you can lose in 20 days. You might say, dang, I wish I could last 20 days losing, right? So the idea is that you're noticing that a smaller account size, a smaller position size. That's all that matters. And that equation is very useful. Why 1.1? You can ask the CME group why they did that. Initial is 1.1 times the maintenance margin. Okay. Just, yeah. I didn't come up with 110. It's their thing. Okay. Now, on this side of the spreadsheet, as you notice, there's a whole different kind of equation here. What this does is what the loss of one risk interval looks like at a certain position size. Okay. So this is taking your net lick divided by your initial margin requirement and giving you a position size. Okay. So again, starting at a 100K balance, if I were to lose exactly on 6 contracts, the total risk interval, it's currently 42. So if I were to lose, and again, that's somebody was in here playing with the balance for NASDAQ. Losing 5 days in a row at the full risk interval, which is not a 10-point stop per trade, but a 42-point stop per trade after 5 consecutive days, you still have half your account left. If for some reason you forgot to put a stop 5 days in a row and you hit that risk interval before you decide to pull the ripcord. Again, it's a nice symmetric way of understanding that 5 catalysts in a row, which don't necessarily happen, like a CPI, PPI, and you gambled in all 5 of those events and lost, each time you're down 12.5%. So now you have half your account after 5 catalyst days. Now, again, you could set this number at any amount that you want, but the rule is your position size never goes above that amount in a real futures account. You understand? When you say what's PA, what do you mean PA? Oh, PA is an Apex performance account, is what somebody's talking about. Apex trader funding. Okay. So any questions so far? If you don't decide what your normal is and you need a way to do it, this is the equation I use. And all my trades you will see are roughly, 6, 7 contracts at the most, usually 2 to 3 on the stream. And that's $2,000 or $3,000 sometimes per trade. Doesn't take a lot, but make sure that if you scale it correctly. If you have $1,000 in your account, or sorry, $10,000 in your account, while you might get $500 margins from your broker, you should be trading 6 micros at the max so that you don't blow up your 10,000. Don't let your brokers discount margins that convince you to buy more than you need to make you buy more than you need to. Throttle your account correctly so that you last in the game. Because remember, what happens when you survive in this game? You make money. The Blind Monkey's strategy, all that it required was what? That he survived at the end of the month with half of his account. That was the rule. And that rule made money. And so here's an equation based on the margin requirement that's the same no matter what the margin requirement is, no matter what, whatever your account size is, whatever the case may be, you will find that it's relatively similar to keeping half your account at the end of a month. So that can set what we call your in position. Throughout the rest of these courses, you will see me use the letters N, M, small, and 0. N is maybe this thing, mine was 6 at 100K, or whatever you decide it is. With the trader funding program, it's even different. With the trader funding program, you're not going to have a net lick. They may say, yep, you have a 100,000 Apex account, right? $100,000 Apex that has a $6,000 profit target with a $3,000 trailing drawdown. Let's just quiz you guys in this class. What's the size of that account for the net lick? Everyone take a guess. It's 3,000. You all figured it out. Y'all are smarter than I thought. You know, the first time I did this class, people were like confused. You nailed it. That is a $3,000 account. Don't let the first number they give you make you think, oh, it's $100,000. That's a $3,000 account. Does anyone understand why that's not a $3,000 account? $100,000 is invisible fake money. If you lose 3,000, you go to zero, you're done. It's like a $3,000 account that falls to zero and you're out. $100,000 that falls to 97, you're out. They can make it $1 gajillion and 1 gajillion minus 3,000 and you're out. It's still a $3,000 account. We got it? So if you need that equation and you're properly trying to scale your position, at least at the PA side, or at least when you're in the funded side, you would take 3,000 as a net lick starting point divided by, you know, whatever it was, 16 or 18,000. And as you see, you're not even trading one mini. You're trading like a couple of micros, right, to get out the door. Now, you may, again, say, you know what, I don't feel like doing that. But if you're trying to trade it up slowly and you need a way to do that, that's fine. When these things are like 90% off and all your trader funding programs are 90% off, go in there and YOLO long those things because they're 20 bucks and pass them in 1 or 2 trades. Don't worry about inching your way forward when the accounts are 20 bucks. Okay? When the accounts are 200 and 300, you paid a lot for them, take them seriously. When Apex has a 90% off sale and I get the 100K accounts for like $21, I think I went and bought, I don't know how many of them I bought. I bought way more than 20. And I just stocked up on them. And each trade I hit with like 5 to 10 minis. And I hit the 6,000 a single trade, busted some of them, hit them, busted them. But I didn't even spend like $1,000 or less to get 20 funded PA accounts because they're cheap. So you have to make that risk judgment on yourself. Once they go funded, I'm not out there trading 5 minis on them. Hell no. Out the door, I'm trading micros, usually on the first trade, just to put some fat on the account. You got to hit your first payout target. You also have to keep your trading consistent and small so you don't bust consistency rules. You don't want to go out there and make 10K on a trade, do you? Everyone here that does trader funding programs. What happens if you go out there and make 10K on your first trade? You're usually slapping yourself in the face after you get denied your payout and go read the rules, right? You're like, oh, I get paid in 5 days. Nope, I got to trade 20 more days. Wait, why? Because of the consistency rule. So remember, this scaling rule also helps you with consistency. You're not making, yeah, some of them may not have it, but you're not out there making big blowouts on your account. If you use this equation, you're trading, you know, relatively close. Let me see what 3,000 would be. If I take $3,000 divided by the IMR, it's like 2 micros. But think about it like this. Oops. Equals 2 micros times 10 points times $50 a point. You're up and down $100, right? That may be like way underneath that 3,000. So you can maybe decide, you know what? These things are cheap enough. I'm going to let this be 1,000 a day. I'll give myself 3 days to blow it up and set it to be 1,000. And that's your comfort level. Then you set it that way as well. But just remember, you need to use this margin requirement as a starting point to inch your way along. This would be what I would do seriously if I'm trying to get paid out on these things. As you see, $100,000 account, you're not really going to make much inching $100 a day. You may want to make it a little bigger, but it's up to you. When it's the cheap $20 account to try to pass them, I hit them hard. Hit them hard, burn through them fast, blow up fast, and win them fast, and not spending a lot of money because they're cheap. Well, no, but this isn't micros. This is 0.17 minis, so I did times 50. So 2 micros is $5, or 0.2 minis is $50 each. But yeah, same thing. Okay. So now when it comes down to position sizing, you're going to have a choice. Every single thing that we're going to teach you is going to come with one of these letters. And I know we reviewed it in the last class, but what you need to do is you need to understand there's a checkerboard. And some of our indicators are entries and exits. Some of our indicators are designed um, for confidence. When you are longing the market, the liquidity map, when we get to that class, will start having like a bunch of N's and a bunch of M's on the diagram. And that diagram will kind of show you what I recommend, how common that trade is or how high probability it is. The current liquidity map, you can click this and it pops up. We have an all new one that's coming out very soon that's going to replace that and replace this just with more information on it. But when it comes to that normal, medium, small, and sit out on a long trade, whatever you choose to start at, if you lose confidence in one of our confidence indicators, which is going to be some of these over here and these guys up here, resilience is up there, but is there as well. If you lose confidence in a long, you get out of the trade. Or you enter the trade smaller if you're entering. If you're in a trade, for example, I'm long the market in a medium and it's going up, and all of a sudden resilience takes a nosedive and it's likely to fill the gap, I need to move to a small immediately. So if a medium is one half of my account, sorry, one half of my position, a small is 1/10. That means trim. So if my normal was 10 as an example, and medium was 5, and small was 1 to 2, it's about 10 to 20%. And a sit out is a sit out. My 10, my 5 contracts here, if I got a signal that just kind of went against my bull trade, but I'm still taking it all the way to my finish line, I can reduce it and take profit and turn my 5 into 2. Trim out. So what you're going to learn is going forward. So Vic has said something in chat. If you stick to the max position size and funded, it takes about 10 to 20 days on average to hit profit targets, as most of them have about 1 to 3 drawdown to profit ratio, and that's about correct. Yeah. So does everybody understand that in a long trade, as you lose confidence, you're going to trim or enter a smaller position or trim out of a position that you're in? Does this make sense? If I'm, as an example, we'll teach you DD band, or sorry, bottom bull zone is one of my favorite longs there is, period. Like, I love this thing. Um, Bottom bull zone, I hit with a normal position all the time. Like, I hit this really hard when the DD ratio is greater than half. And you will see a lot of our conditions and trade setups are like this. I'll hit it with a normal. If the DD ratio is less than half, meaning that the stocks aren't bullish enough to support here, then I have less confidence that the S&P is going to bounce here. I'm going to hit it with a medium instead. So if I bought the dip right when it gets here, I look at the number and say, okay, it's good. I'm going to hit it with a normal. If I long with a normal and it's going up and up and up and up, and all of a sudden the ratio drops below half, yet I'm still holding on to the trade, then I trim half of my position. Do we all understand the scale? I'm trimming half, more than half, and then all. If I lose bull confidence, I still always take a bull trade. I just trade it smaller. Why do I always take a bull trade? Why do I always take bull setups when I find them in any environment? You will notice that a lot of the setups are here in any environment. Crash market, that's not triggering a risk interval to sit out, but sell-off market, any of those. I'll take bull targets. Why am I always trying to take a bull target? Why am I always trying to buy a bull bounce in any case that I can? What'd you learn yesterday? Market tends to go up most of the time. So I'm going to take every opportunity to try to bull the market if I can. Right? So when I'm losing confidence in the bull side, I'm still stepping down on my trade. If another rule of thumb, the greater market, as we'll teach you that in that class that comes up, you have 3 indicators that indicate the greater market. DD is one of them, MHP is another, and monthly map is a third. You can use these as gauges to also step down your longs. Okay. So resilience and DD are pretty much 2 of the indicators that allow me to understand direction against me. An example today, you guys remember the trade I made on stream today, is that the S&P was trading way down inside of here, but resilience went above 0, so I was expecting this to pop and fill the gap. So I longed right here. but I only longed it with 2 contracts. Why didn't I hit it with 10? Why not 5? Well, so we were breaking hedge pressure, -1. Okay. My checker moves here, even if I started with a normal, right? Number two, Nasdaq resilience was less than 0, -1 again. So I'm going to take it with the smallest position I have, which is roughly 2. And I took 2, and then boom, it popped, right? So I had things that didn't agree, right? I had a caution here, which is this red light right there. I had Nasdaq kind of looking booty as well, which is a caution there. So I hit it small. I didn't hit it with 10 contracts. The market's not likely to rally and break out that easily, but at least I'm just trading on the pop. My confidence is what let me trade small. You guys remember 2 contracts on stream wasn't much. Now, in a short trade, remember, short trades are traded different. While long trades tend to mosey up and become less volatile as they go, short trades tend to become more volatile as they fall. You want to find every excuse you can in a long trade to trade the next resistance and then maybe trim a runner, trim and hold a runner. I do that all the time. In a short trade, I'm never trimming and holding a runner. If I get my short trade to next resistance, I always close all. This is a rule of thumb that everybody, or a rule, sorry, that everybody needs to do. Trading long, I usually trim on the way up, take some profit at my first target and let it go to the next one because bull markets like to be bullish. Bear markets like to rally back up. So I don't trim and hold a runner on a short. Never. I repeat, never. When you get your short trade and when you make money, you put it all in your pocket. Don't hold a runner to let your runner give back most of your gains before it makes a little bit more. It's not worth it psychologically to -5 here. You make a whole lot of money. Then you close out 3 of them to hold 2 in case it keeps falling. And then the 2 gives most of your gain back and then falls, especially in trader funding programs. Do not hold a runner if you're shorting. Why is that a bad idea from what you learned yesterday or your experience with trader funding programs? Why hold anything at all? If the short trade moves very quick and it's volatile, it's going to V back up really quick. So why hold a runner on a short trade? How does that hurt you in a trader funding program? Think trader funding program in this specific question. Trailing stops. Kulu nailed it. A trailing stop. You could have made all kind of money with the 5 and closed out 3, but then the 2 that you had in your pocket still holding on for a little bit more might have drew you down to where now you're $500 away from blowing up, even though you're $2,000 profit. Trailing stops are the reason to not hold a runner on a short. So in a short, get out once you get your target. You understand? When markets are volatile, no runners. Everyone write it down. No runners. Get your trade, get in, get out. Shorts are the quickest trades you do when we find them. No runners. Okay. Additionally, when it comes down to normal, medium, small, and sit out, any scare you have that prevents you from shorting, don't risk trailing drawdown problems. If my trade was, ooh, I'm going to hit it with a normal, ooh, but resilience doesn't agree. It doesn't matter what you choose. In a short, write this down. You need unanimous confluence. For markets to fall, the rare times that they do, what percent of months, pop quiz, are red? You remember from yesterday, just a pop quiz? In the last 10 years, per our test, Ian came up with like the 30-year thing. Roughly 30% in the last 10 years were red, right? So markets, and remember, of those 30%, roughly 60% of those had a wick at the bottom and gave it back up. Markets don't like to stay red for longer. Even in the month scale, it doesn't stay red. You know, markets tend to not really just fall, keep falling, keep falling. That's rare that happens. In this entire year, we had maybe like those 2 crash days in August and maybe like 5 crash days in December. It was pretty much it, right? Where the market fell apart, maybe like fewer than 10 or 15 days for the entire year. It's not rare that you just planted your money and it market fell to oblivion. So shorting is in quick, out with all quick. And if anything scares you out of the trade, trim all of it immediately and never hold a runner. So if I'm shorting off of MHP, it's the next resistance. Boom, get out. If I'm shorting off of MHP, next resistance, boom, get out. Don't hold a runner that it chops you around like that. Take your trade and get out. Because long trades don't have volatility while short trades do. Do we understand that we trade them differently? This is going to put you miles ahead of the next trader in that Your risk management is seen as different. You're always trying to become a bull because the majority of months and days are bullish. When Rocket Scooter's greater market lines up, we counted on stream 69% of days were bullish. We did this on that YouTube show that one time, right? So greater market is all bullish with VIX in the right spot. 69% of days are green. So you're always more comfortable longing than you are shorting. I want you to write that down. I'm more comfortable longing than shorting. Even though you may not think it now, you will be because the market is in your favor. The statistics are in your favor. The long trades, you need to kind of just manage them a little bit more. Short trade is get in, get out, take the money and run. Okay? What questions? Any questions about this principle right here? When I am in doubt, I step down on my long. Each thing that gives me doubt, I step down one time. It's just a nice little rule of thumb. In a short, anything that goes against my short, I'm out. I buy the next resistance, I'm out. I'm shorting the market, then all of a sudden monthly res flips positive and oh, I'm out. Right? Don't let the idea that the market is ready to be bullish on a moment's notice. Let that idea that the market's ready to be bullish on a moment's notice. Shorts are squeezing super quick because markets are volatile. It doesn't take long for markets to bounce right back up. That you don't want to hold through shorts to bet the markets crash. You're going to make most of your trades per whatever the market's handing you, and majority of the days are going to be bullish, right? Okay. This is just a class to get you started on the position sizing that you can understand. Going forward, every single thing that we're going to teach you, a liquidity map is going to show you flow in basically futures that matches flow in equities. It's going to have a position size that goes with it. And then you're going to have conditions that say like A, B, C, or D, what you do or don't do. For the most part, you're going to have conditions, the DD ratio at the bottom bull zone, resilience inside of this box, general irrational rules like callus or active or hedge breaks and things like that, or DD band break, are going to change how you trade as well. Each class will show you those conditions. There's a certain confidence that comes with certain things not lining up. And so when I lack the confidence, then I don't make the trade. Any questions? Okay.